And welcome back to the marketplace. This afternoon, we have been reporting a 15% drop in treasury rates, and we have heard from an economist warning that if this is not properly managed, it could have serious implications on the economy. Joining us to discuss on phone is Nelson Kuagbedzi, who is head of finance at UMB Capital. Thank you so much for joining us on the marketplace. First, talk to our audience about why we are seeing rates drop. What is driving this change?
All right, thank you very much for having me. The rates are dropping basically because of government lack of appetite to borrow from the short-term market. You realize that as the month-on-month variation of rates stands at 45.50% for the 91-day Treasury bill, and that of the 182 days, the percentage reduction is 41.0% month-on-month. That tells you that the government, in their quest to reduce the debt, the unsustainability of our debt level, has decided to shy away from the market. Don't forget that this issue of Treasury bill is an issue of demand and supply. And so if the supply is more and the demand is low, technically the price will fall. So it's as a result of demand and supply in the market that is actually accounting for the sharp reduction in the price. Right. You will notice that the 91-day Treasury bill a month ago was at 27.98%. Currently, the 91-day Treasury bill is at 15.25%, representing 45.50%. The 182-day Treasury bill was 28.68% a month ago. Currently, it is at 16.92%, representing 41.0%. So it is technically an issue of demand and supply, and the fact that government doesn't want to borrow a lot in order to increase the debt stock.
Yeah, so Dr. Chimesi Bafo, in that clip we saw earlier in the bulletin, talked about the fact that the drop we are seeing is not in sync with other economic indicators like inflation and the monetary policy rate. Again, explain to us why this is a matter of concern. If there's a misalignment, how does it impact the economy?
Well, I think the misalignment, the picture will be clearer. Don't forget that Treasury bills are raised by the government on weekly basis. Inflation data is computed month on month. And so the expectation is that by the time we have the third quarter inflation data for 2025, the picture will be clearer as to what is exactly causing the misalignment. But let me give you a bit of a data.
Okay.
Inflation as at the end of 2024 was 23.8%. Inflation as at the end of 2024, December, was 23.8%. Inflation as it stands at February is 23.1%. So it means that there is a marginal reduction in the rate of inflation. Now, per the Ghana Statistical Service, the major driver for inflation is food. And so food inflation is what is accounting for the higher inflation that we are seeing today. The question that you ask yourself is, if food inflation is a major cost driver for our inflationary basket, what happens to planting for food and jobs 1.0 and 2.0? Is it that the implementation was not successful? Okay, and currently, this current government has also allocated 1.5 billion Ghana cedis for the agriculture for economic transformation. Now, the problem of this country is that we have beautiful and nice policies. The implementation has always been the problem. The quantum of money that was sunk into planting for food and jobs could have translated into a reduction in our food inflation. But the opposite is what we are witnessing now. So I believe that when the Ghana Statistical Service comes out with their inflation data for third quarter, the picture will be clearer for us to know what is actually accounting for the misalignment. Even though inflation is reducing at a marginal rate, the rate at which interest rates for Treasury bills are reducing is sharper than that of, inflation. So the picture will get clearer even as we head towards the medium term.
I mean, what specific risks will we be looking at if the rates continue to drop without proper management?
All right, as an investor, I will always want to have returns on my investment, most especially when it has to do with government securities. Currently, you realize that anybody at all who goes into Treasury bill investment will be having negative real rate of returns. Because inflation is at 23.1%, then Treasury bill rate is at 15% and 16%. Clearly, that is a loss. And so if the reduction in the rate continues, what it technically means is that investors, both foreign and local, both individual, retail, and institutional investors, will also shy away from the market and look for other profitable alternative investment vehicles that they can put their money in. And this is a challenge. This is going to impact heavily on pension fund managers. It is also going to impact heavily on banks and insurance companies. Because after they have gotten all their money from their clients, they need to look for a place to put their money. If the rate of inflation is higher than the rate of government securities, then it means that these investors will shy away from government securities and look for other alternative investments like real estate. They can also go into the stock market. Currently, the performance of the stock market year to date is 24.97%, which is also a little higher than the inflation rate. What it also means is that government may not be able to raise the needed, fund within the short term for the purposes of refinancing maturing obligations.
And I believe investors are watching this. What does this do to investor confidence going forward in the bond market?
Well, I think we shouldn't restrict ourselves to the bond market, but it should be the broader fixed income market. Once the rates in the fixed income market are reducing or reducing sharply, no investor will want to go into the fixed income market. They will rather shy away from the market, and as I did indicate earlier, look for other profitable alternative investment schemes. The next available investment that they can think of is the stock market. However, the stock market is also not doing too well. As I did indicate, the year-to-date performance of the Ghana Stock Exchange is 24.97%, which is slightly higher than the 23.1% inflation figure. So the stock market may also not be a suitable investment alternative. Maybe they can also look at bank FDs, but the question is, can the banks be able to absorb the excess liquidity in the system? No, they cannot. Secondly, they may also consider going into real sector investment, for instance, real estate. But the question is, real estate in Ghana, what is the status? Can you invest in a house today and sell it tomorrow? That sector is also illiquid. Can they go into commodities? So clearly, you will realize that the other investment alternatives available within the Ghanaian economy cannot also satisfy investors, both local and foreign.
So I'm just wondering, what specific actions can the government take to ensure that the Treasury bill rates at least align with inflation, the monetary policy rates?
Well, I think that government borrowing, the borrowing strategy of the government must align with monetary policy objectives so as to avoid the current distortions that we are seeing in the market. The government should come out clearly to tell us their borrowing strategy for the medium term. And once the borrowing strategy is known for the medium term, then the other economic indicators can also fit in. Don't forget, the overall objective of the government in terms of reduction in the interest rate is to reduce significantly the finance cost that they will pay. In fact, the Honorable Finance Minister indicated that within the next 4 years, Ghana will be paying over $8.1 billion in terms of debt that they have to repay. The Commissioner General for Ghana Revenue Authority says he will be mobilizing 200 billion Ghana cedis. Now, when we are mobilizing 200 billion Ghana cedis, even with an incremental jump of 20% a year, that cannot even satisfy our debt obligation within the next 4 years. And so I think that the government strategy of borrowing should align perfectly with their monetary policy so that we avoid some of these distortions within the market.
All right. Great analysis. The head of finance at UAB Capital, Nelson Kuagbedzi. I appreciate your time on the marketplace. Hopefully we'll have you on another time. I appreciate it so much.